I'm Owen Bigland. This is the Inside Edge video blog. Okay, it's Saturday, so time for one of my investing mindset, the positive attitude you have to have for success. And as you guys, I think I told you a couple of weeks ago, this is going to be one of my rare Saturday blogs for the summer. I'd love to be able to do these every Saturday this summer, but I am going to be away a fair bit. So I'll try and do a couple of these every month for the next 2.5 months or so. So don't expect one every Saturday, but I'll do my best. We'll get back to a regular schedule after Labor Day for sure. But wanted to talk, of course, about the stock market these days. The S&P 500, the Dow, the NASDAQ, the TSX, very volatile, crazy swings, up 600 points, down 1,000, up 400, down 500. As I speak right now, the S&P 500 is down about 25% year to date. NASDAQ is down 30%, close to 30%. TSX has been a little better. It's only down about 10%. This is the worst first half in the market since 1970. Terrible. But, a lot of people ask me, how do you stay the course? I mean, it must be rough looking at a portfolio of my size and these kind of ups and downs. And it really isn't, only because I've been doing this for so long and I know this is par for the course. I've been through so many of these. So I'm going to tell you guys one of the ways how I look at my portfolio to help you guys stay the course. And if you've read my book, Along for the Ride, in chapter 7 in this book, in my book, I talk about portfolio construction and how I look at my portfolio. So I came up with and I'm kind of pretty proud of myself, myself and my co-writer of this book, Nick Rathel, based in New York. We came up, and because I'm in real estate, we came up with the premise of how I look at my portfolio. I look at my portfolio like I own a 45-unit apartment building in Mount Pleasant in East Vancouver. That's essentially what I own here. I have a real estate portfolio. I also have a large stock portfolio, but I look at my stock portfolio like I own a 45 or 50 unit wood frame apartment building. And what I mean by that is if it's 50 units, every unit represents a stock or a company that I own. And we'll say, the first 2 floors, we'll say, or the first ground floor has got 10 units in it. Those 10 units are my ETF holdings, my index investing. That's kind of the foundation or the core of my apartment building. And in unit 101, I have VIG, Vanguard Dividend Appreciation Fund. In unit 102, I've got the S&P 500, the VOO. In unit 103, I've got XEI, which is the Canadian High Dividend. In unit 106, I've got VXUS, which is a Euro fund that holds couple hundred of the best European stocks like Nestle and Novartis and BP and those kind of companies. In unit 108, I've got the Triple Q, which is the NASDAQ 100. You get the picture. On the second floor, third, fourth, and fifth floor, I have in every unit a holding. In unit 102, I've got the Johnsons. Mr. and Mrs. Johnson, Johnson & Johnson. I've got, in unit 208, I've got the Proctors and the Gambles. In unit 304, I've got the Apples. I look at my portfolio like an apartment building. The nice thing here is that the large percentage of my portfolio, probably 80% of my holdings, pay me a quarterly dividend or a rent check, just like you would from tenants from an apartment building. And those rent checks are fat. In some cases, for instance, with a mutual fund or a ETF like XEI, I get that check monthly. They pay a monthly dividend on that fund. But for most of my individual holdings, like an Apple or a Johnson & Johnson or a Visa or a Home Depot or a Costco or a Bristol Myers or a Royal Bank or a TD Bank, these are all tenants. They pay me a quarterly rent check instead of a monthly rent check. But one step better from actually owning an apartment building, unlike BC, where the NDP froze the rent increases for 2 years during COVID, and then this year in 2022, give us landlords a measly 1.5% increase. It's ridiculous. My equity apartment building is far better than that. Most of the companies I hold not only pay a dividend, but increase that dividend every year. They're what's known as dividend aristocrats. And better yet, it's far more than 1.5%. A lot of my companies, like the Canadian banks, the US banks, many of my holdings are increasing their dividends 10, 15, 20. I've had some that have increased their dividends 100% in the last year and a half, doubled the dividend. If you follow me on Twitter, oftentimes I will tweet out some of the incredible dividend boosts I'm getting from my companies. FedEx just increased their dividend by 50%. 2 days ago, the US banks, Morgan Stanley increased their dividend 11%. Wells Fargo increased their dividend 20%. Goldman Sachs increased their dividend 25%. So you get the picture. The average dividend growth rate on my holdings right now is easily into double digits, probably 10 to 15% on average. When you've got inflation running hot at 7 or 8%, you're still doubling. Your growth rate is still double what the inflation rate is. So you're bulletproofing your income there and your portfolio. And listen, inflation will get back under control here. It's average more like 2.5%, which is incredible. I've got an average dividend growth rate of 10 or 12, and inflation's running at 2 or 3%. So the goal is, if you've read my book with me, I could care less what the underlying value of my apartment building is at. That will go up and down in wild swings. 1 year, my total portfolio, this apartment building, will be worth $4.5 million. Next year, it might be worth 5.5. 2 years, it might go down to $4.9 million. It's going to go up and down. Over the long term, though, 15, 20 years, if it's worth $4 million today, 20 years from now, it'll probably be worth more like 10 or 12 million. That's just the way the stock market goes in the long term. In the short term, though, all bets are off. So that helps me stay the course. I know that time and compounding will take care of business for me. But what helps me stay the course is this dividend income will come in rain or shine. And with a portfolio my size, and you guys can get here too, I'm generating well over $200,000 a year now in dividend income from my Canadian banks and my Johnson & Johnson and my Apple shares and my Unilever and all the companies that I hold. You know, that money comes in rain or shine, and if you generate $200,000 this year in dividend income, if you've got an annual, without putting any more money in it, just the dividend growth rate next year on it, I might get 215, 220, 230 from doing nothing. So I'm more than keeping pace with inflation. In my book, I give you in all the details, but that will help you guys stay the course. Buy some companies that pay you a nice dividend. You know, I call it kind of the barbell approach. I have a lot of companies like Google, Amazon, Meta, that pay no dividend at all. And then I've got a lot of companies that pay me a very low dividend, but they're growing that dividend. Right now, the yield is maybe less than 1%. Brookfield Asset Management, Visa, Costco. Disney right now isn't paying a dividend. They will probably reinstate it later this year, but they stopped their dividend during COVID. But for the most part, so that probably makes up about 15% of my portfolio that don't pay a dividend, or a low dividend that they're starting to grow pretty quickly. The other 80 or 85% pay me a fat dividend check quarterly or monthly, and they have a long track history of increasing that dividend. Those dividends are going to be coming in. These companies are incredibly well run. They're cash flow machines. That's what the dividend is. It's excess profit that is dispersed to the shareholders like you and me. So that will help you stay the course. If the Dow is down 20% this year, I'll still have several $100,000 coming in dividend income, and that will keep growing. And I'm at a stage where I'm still working. I'm not retired. I'm not living off my passive income flows yet. I'm going to. So I just take that money and reinvest it into more stock, which compounds it even more the following year. So it starts from small beginnings, though. You know, I've been at this 35, 36 years as an investor in the stock market, and pretty much the same length of time as a real estate investor. I start with one property, go from there. You buy one share of, with me, it was 10 shares of Pepsi back 34 years ago. I've bought many more since that time. My yield on cost on Pepsi, look it up, probably 20 or 25, 30%. I don't even know, based on the current dividend, cash dividend they're paying compared to what I paid for that stock with all the splits and spin-offs and everything else. Start small, just enjoy the ride, like I say in my book, and just let time and compounding do the trick. But I look at my portfolio like an apartment building. Try it. It'll help you guys stay the course. Every unit is a stock or an ETF, and they're paying you a rent check every month or every 3 months, and just keep rolling that back into more shares. And in 20, 30 years, you will be in the same situation I'm in. Set aside 15, 20% of what you earn every month and put it in to get it working for you through real estate and stock. But hey, if you haven't bought my book, I haven't plugged it here for a little while. On Amazon right now, still a bestseller. Look at the reviews of my book. Thanks for everyone that continues to buy this book. I'm selling 20, 30, 40 copies every month on this still after 5 years. I think it's a good meat and potatoes book on how I became financially secure at a fairly young age in my early 40s, and how, my goal here, and I could do it now, I've got a big enough real estate and stock portfolio that if I chose to quit working as a realtor, I can comfortably live off the cash flows here, passive income flows, without having to sell anything. And that's bulletproofing your portfolio. I'm Owen Bigland. Enjoy the weekend. I'll see you next week.